Hey, welcome to the Options Moneymaker Q&A session. Today is March 18th, 2020. I'm Mark Dannenberg, and I also have Aaron Rumley and Michael Kastner with me here tonight. Hey, guys.
Hello.
Okay. If you're brand new to our Q&A, if this is your first time, the whole purpose for the Q&A is to help you learn to trade and then trade to earn. There's learning that's required in most any activity. If you jump into it right away without applying any kind of discipline to learning, you will have a less probability of success. So that's what we're committed to. We're here to help you learn. We provide tools and strategies and techniques that we know have been time tested and proven, and they're designed to help you be successful. So learn to trade, trade to learn, trade to earn. So we're going to open up for Q&A here in just a few moments, but first I want to share some of what's been going on recently. The Q&A that we have is designed for you to be able to ask questions. Any part of what we teach, any part of what we do in our live trading room that you may require a little bit more explanation, a little clarification on, we're here to offer that. We make ourselves available every 2 weeks because we know that not every question can be answered just through the education material, and so we're here to help you really clarify things. That includes the profit flow analytics charts. We use those for identifying our trends. That includes the masterclass for the profit flow analytics charts, and with the masterclass comes the Cycle Finder Plus, which has been just a very spot-on dynamic signal for us identifying signals, cycle trends. That includes the live trading room for real-time trading and support. Generally, we have time in the live trading room to answer questions, but if not, this Q&A is a perfect opportunity for you to pose a question that we have undistracted time to respond to. Profit Builder Plus is our options education program for people who may not understand yet how to trade options properly. This particular market that we're in is requiring that you have a certain level of knowledge. Now, we're guiding people through in our live trading room, but if you really want to become much more comfortable with and familiar with options strategies, the Profit Builder Plus is a great program for you. We do provide futures trading education so that you can learn the risk and reward of futures. And we also provide one-on-one coaching for those select individuals who are seeking a more intensive immersion into learning how to trade. And those are usually scheduled sessions that are once a week for one-on-one coaching. So that's really what we cover. That's where the majority of the questions are sourced from. So we talked 2 weeks ago about volatility. Volatility has returned to the market. We've had some extreme volatility. I've kind of lost track of the number of days that we've had lock limits where the market has halted. Overnight, futures markets have halted. Futures trading has halted. During the day, we've seen the S&P 500 hit 7% move off of the prior day close, and that shuts down the market for a 15-minute period. So prior to, I think it was Monday of last week, we hadn't seen this in a very, very long time. And just in the last week and a half, we've seen it, I believe now 4 times. So there's definitely a significant increase in volatility. There's a significant increase in the amount of fear that is embedded in the market right now. What we are asking our traders to do is to just set that aside, set aside the news. You can't do anything about that, but what you can do is to come to the market every day prepared to follow signals that you trust. Follow along with us in the live trading room. We are committed to helping you identify the right timing for entries. And we're trading a watch list of stocks, and we're trading a watch list of futures contracts, as well as the cash indexes. But we ask you to come to the market every day prepared to follow those signals and set aside all other preconceived notions. It's worked very well for us in the last 3 weeks. I'm going to share some statistics with you here in just a minute. Erin's put together a summary for us. But the profit flow analytics is a key to being successful, and particularly the Cycle Finder Plus. It is a key to entering a position regardless of what your strategy is. The 4 primary strategies that we use in the live trading room are trading futures, trading the micros, which is a smaller version of the futures contracts, trading options on the cash settled index like S&P 500, NASDAQ 100, Russell 2000, and then also trading options on ETFs, which are the IWM, SPY, and the Qs, and then also options on stocks. We have a short list of stocks that we track, and we trade options on those stocks. Now, we trade both futures and options in the room. I've been very clear in our live trading room I'm referring to. I've been very clear in the last couple of weeks that I'm personally not trading futures right now. There is too great of a risk of drawdown, meaning being stopped out on a futures contract before the movement is favorable, where you could realize a profit. The advantage of trading options right now, and this is part of the flexibility that you need to incorporate into your trading, but the advantage of trading options right now is there's a time advantage. If I go out 3, 4, 5 weeks, even 8 weeks to expiration, and I put on a trade, it's not that I'm intending to hold the trade that long. It's just that I want the flexibility to be able to hold as long as the chart tells me that I should stay in the trade. I don't want to be stopped out of the trade if the chart is telling me that I should remain in a short position or remain in a long position. I don't want to be stopped out of that trade if the signal is indicating that I should remain in that position. So options have a time advantage. Bottom line is, I think it's good to understand both options trading and futures trading, because we're going to go through market cycles where volatility is high. Options trading right now is proving to be the best strategy. Futures trading is generally better when volatility is more significantly low. You're getting the movements you need. You're getting the in and out transactions throughout the day. So you just have to be flexible. That's what we're trying to do. We talk about this every day in the live trading room. So if you're already part of the live trading room, it should be no surprise to you that I personally have been shifting to options. So let's talk a little bit about what we've been doing. Erin, do you want to walk us through this?
Sure. So since we really started to have the spike of volatility, which happened around that last week of February, there have been 30 daily crosses on the stocks and indexes that we monitor on our watch list. Based on their sweet spots, there's been 29 profits and 1 loss so far. And then based on a 30 delta, just to really average it all across, based on a 30 delta, the total profit is $94.54 per share, which is $9,454. And that's just based on 1 contract from February 24th to today. So it's averaging about, with the 30 delta, $3.15 of profit per share, which is about $315 per contract per position. And it's been an average of $525 of profit per day. These are the daily crosses that are based on our Cycle Finder Plus and that are taught in our master class using our profit sweet spot matrix.
So here's what happens every morning. When the regular market session opens at 9:30 Eastern, we take a look at our watch list of stocks and indexes, and Erin monitors whether or not we have had a cross, what we refer to as a cross, of the 2 trending lines on the Cycle Finder Plus indicator. If we've had a cross up, then we buy a call. If we've had a cross down, then we buy a put. And we just follow that along. Erin trades these, many of these in her own account, and they are historically um, historically, they have been proven to be very high probability trades. We have a tool that we released along with the masterclass, and it's called the Profit Sweet Spot Matrix. And it actually tracks all of these daily crosses back from January 2019 forward. And it measures which ones were wins, which ones were losers, and we come up with a total value in terms of profits if you're trading a single contract. So there's a lot of integrity in terms of the daily cross based on the Cycle Funder Plus being a profitable method to trade. We talk about these first thing in the morning when the market opens. The last couple of weeks, we've still had good trades, even though volatility has been extremely high. But Aaron tracks these, and you can see here that we've had 30 trades in the last, it's about 2.5 weeks, and 30 trades, 29 wins, and 1 loss. That is phenomenal in my book, because what we've done is we have majorly stress tested our signals, our analytic software, and the metrics are proving to hold true. And we're pretty excited about that, because what we're doing for people in our live trading room is help them achieve a level of profit from these. In the midst of turmoil and chaos in the market, where a lot of people are very fearful about their retirement plans, about their 401ks, even about their livelihood. So we don't at all diminish the fear that's out there. We just choose not to participate in that while we're trading. We're going to focus on our signals, and we're going to do everything we possibly can to help each of you participate profitably in the market. So there's a second category of trades that we track, and it is our option strategy that we've been using since the 25th of February, which allows us, it's a strangle, it allows us to take a position where we know if the market moves strongly in one direction or the other, that we will have an opportunity to take a profit. So it really doesn't matter which direction it moves. I explain in the room, if the market's moving lower, our profit comes to us more quickly. If the market moves higher, we still can earn a profit, but it may come to us a little bit more slowly. And in the live trading room, we emphasize how to choose the right expiration for these trades. When I'm trading these, because I'm trading every one of these in my personal account, when I'm trading these, I announce them in the room. Lots of our community follow along with these trades too. So what have you found so far, Aaron, on the strangles?
It's really hard to keep track of our win percent. I have to mentally calculate it all the time, and throw that 0 in there, it confuses things.
Do you need a spreadsheet for that?
I actually have one for it anyway. So we've done 38 strangles since the 25th of February, and all 38 have been profitable. We've taken these in the room. If you've been in the live trading room with us, we have heard from so many of you that you've benefited from these strangles. Our total profit since February 25th is $166.09 per share, which is over $16,000, $16,609, and that's only based on one contract. So if you opened up 2 contracts of each position, you're looking at something over 32,000, really 33,000. So this has been, as Mark said, a very productive way to trade the market. We're averaging $437 per position per contract, and the longest we've been in a trade is 3 market days. So we've been averaging $977 a profit, so very close to $1,000 a profit per market day, which, if you think about it, is really great, because that $1,000 just on day 1 covers your live trading room subscription and covers your Profit Flow Analytics subscription as well.
Yeah, so not everyone will trade every position that we call out in the room. And I get that. But, here's the opportunity. The average per day in the last 2.5 weeks for the daily crosses is about $525. On top of that, we're making an average of about $975. So we're about $1,500 a day. About $1,500 a day if you took every one of the trades and if you only traded one contract. I know many of you, because you share with us in the room, are trading 2, 3, or 4 contracts. Some of you trading more than that. So if you didn't take every single trade, given that they are all winners, except for the one of the crossovers, you have a huge opportunity to have generated an income for yourself. I don't see this changing going forward, folks. We may modify the strategy that we're using because eventually volatility will start to decline. So we may modify the strategy, but the crossovers are something that we've been tracking since January of 2019. We've gone through a period of market record highs in the market with ultra low volatility to some pretty profound movements lower with and just in the last 3 weeks with extreme volatility. And through all of that, the daily crosses have been very consistent in terms of their performance. The strangles is a strategy that we have traded, I've traded for years, but we use it when we believe that the market conditions warrant it, and that has warranted it in the last 3 weeks. So we are here to help guide you. We're here to help teach you, and we're here to help you earn. That's really what our objective is. We want to help you learn how to earn. So you're going to see us modify strategies. You're going to see us sometimes just buy a call or buy a put when we're trading options. Sometimes you're going to see us trading strangles. Now, we're sharing with you the performance results of the daily crosses and the strangles. That does not take into account the futures trades that we see every day in the live trading room, and it does not take into account what we refer to as midday trades. Today, as an example, we had Booking. Booking had a perfect setup. I mean, it was a textbook setup on the chart indicating that the price of the stock may move higher. Now, that might frighten some folks because the overall market had been selling off, and Booking happens to be one of those stocks that's in an industry that is dramatically affected by the decrease in the travel industry. But the signal provided us confidence that we should go long. So we took a Booking trade and we closed it out for I think it was $3.50 a profit. I'm sorry, $3.30 a profit. And then we had a second opportunity within the next hour to take a second Booking trade, and we were able to close that out for about $7 a profit. So we're taking the signals as they present themselves to us. We will have trades that don't work out. We will have losing trades, but our experience with the signals, the new cycle trading and analytics, profit flow analytics signals, particularly the Cycle Finder Plus, are so solid with so much history in terms of our use of them and our testing of them that we feel very, very confident in taking those. So we just kind of wanted to give you an overview of where we are at this point because, frankly, I know a lot of traders out there who are following along with some other groups and they're not doing very well, or they're trying to do it on their own and they're really suffering, either trading in their IRA or trading in a cash account, and they're really kind of taking a hit. We don't want you to take a hit. We would like to be able to do everything we possibly can to help you not only survive through this very challenging period that our country and other countries in this world are experiencing, we want you to thrive through it. That's really what we want you to do. So any way that we can help you, please let us know. The live trading room is the best place to be, in my opinion. You get ongoing education throughout the day. Michael is phenomenal about helping to identify price targets that we may move to, either higher or lower. tracking those. And together we are identifying entry signals based on the metrics that we have. And we call out trades and we tell you when we're taking a trade, we tell you how the trade is performing. And if the trade needs some sort of management or adjustment, we certainly will let you know about that also. Michael, do you
Mark,
have something?
yeah, I do. And like I said, while you were talking, I just said I'm gonna pull up Tesla and look at October and August of 2019.
Hey,
So because
hold on 1 minute. Let me jump to the chart then, Michael.
okay,
And I'll put that up in front of everybody.
okay.
You're looking at daily chart?
Yeah, oh yeah, daily. Just look at just the daily. Just if folks say, well, this is a great time to make money in options. It is, but are you telling me that it doesn't move any other time of the year? So if you go back, even if you look back into, I'm talking about going back to July, August of looking at Tesla. I mean, you can see several days when the market when Tesla opens up on one day, opens up at 234. 4 days later, it's sitting down at 210. So that's almost 24 points of movement. I mean, sure, it's not moving 100 points, but it's not going to be sideways. It's going to move. Google's going to move. Amazon's going to move. So I mean, we're in a great time right now. But when you say that we'll adjust, the only thing we're going to adjust is our strikes and maybe our time. We'll always have time built into them, but the closer you get to lower volatility, the closer you can get to the strike price. So, and still have a good chance at making a good profit. So,
and
I just think it's important because I've just heard the naysayers. Well, it's a great time. Well, yeah, it is, but the market don't stay still. It's still going to move.
And it's not a great time if you don't know what you're doing.
True.
It's a very frightening time if you don't know what you're doing. But Michael's point is very well taken, that you take yourself out of the current high extreme volatility where we've seen this major sell-off, right? And you see this more mundane movement in a stock, you still have movements. And his point is, if a stock in our watch list is moving 20 or 30 points, that is plenty for us to be able to take a profit. And the daily crosses, so we're on a daily chart here, this is what we refer to as a daily cross. Daily cross is when this blue line on the Cycle Finder Plus, which is called the lead line, crosses above the red line, which is the basis line. And when that happens, just randomly as an example here, the stock opened on that daily cross at $230, and it went up to $243. Well, if you're trading a 50 delta, that's a 6.5 point profit right there. Well, that's $650 on one contract.
And it's all relative, Mark. Like you said, I mean, the delta is going to drop, but like I said, you can get closer to the strike price.
You can get closer to the strike price, and you can generally leverage more contracts.
Yes.
We've got some trades right now where we might only be taking 1 or 2 contracts because of the extreme, because the premiums are high right now on options because of extreme volatility. So we might only be taking 1 or 2 contracts, but we're getting generally a bigger profit on those on a per share basis. So on lower volatility, we might have lower profit per share, but we have more contracts, and you're closer to the money, so your delta is higher. So it's this, like this accordion that, you pull it out and it's more extreme, and you push it in, and you're much closer to the money, and you're able to take advantage of the same strategies. So I think that's a really great point, Michael.
Yes. And if you look at Amazon, it moves 100 points during the low volatility. I'm looked at a couple of trades, that between October and November, or even September. I mean, there's 100-point moves because how Amazon is. I mean, it's just very volatile, even when there's no volatility.
Well, so the stocks that we actually have on our watch list, if you're not familiar with the live trading room, are Amazon, Booking, Google. Netflix is something I was just trading today. It's in my watch list, but we don't trade it as often. But we do trade Shopify and Tesla, and then we trade the NASDAQ 100, the S&P 500, and the Russell 2000. So Amazon is a great example. One of the reasons I like trading Amazon is you've got this rolling, cycling pattern. Look at all that rolling, cycling movement. And our Cycle Finder Plus offers us an opportunity to catch those movements. Here's a Cycle Finder Plus signal that says to go short, basically buy a put, and Amazon opened at 1804 that day, and the next day dropped down to a low of 1747.
Mm-hmm.
So you're talking about 55 points of movement. If you're trading a 50 delta, you've got 25, easily 25 points of profit, and that's in the, just within one day to the next. So we're pretty excited about the new cycle trading and analytics metrics, particularly the Cycle Finder for identifying the beginning of a new cycle. And then the other important thing is applying your strategy. We have enough experience to know when to apply a strangle or straddle strategy versus just buying a call or buying a put. We did this was a little extreme, but we did a strangle strategy as an Amazon earnings play. And you can see here the huge gap open the next morning. And we took like $66 of profit on our strangle. So we're going to keep doing what we're doing. And my point is, we'd love to have you all come and join us in the live trading room. Our mission is to help you make money, if that's what you would like to do. All right, so Randall says, I really appreciate your teaching. Well, thank you, Randall. We, Aaron and Michael and I all enjoy doing it, enjoy helping people. I just got back to watching the daily live trading room last week after a month or so off. Began following the strangle positions on March 10th. Did not do every one that you did, but was able to enter 16 positions, all filled and closed for a profit. I actually entered my own position this afternoon on SPX, entered at 4:07 p.m. and closed at 4:12 p.m. Wow. Made $220 on that position. Learned from great teaching over the last 10 days. I have earned $7,272 using just one contract since March 10th. That's phenomenal, Randall. We're just super excited. I know I'm super excited that you're here and that you're also willing to explain how you have done. So thank you for sharing that with us.
Mark, Michael's asking, has the wide bid-ask spread been an issue with closing the trade?
Not at all, Michael. So I actually don't even pay attention to the bid-ask spread, especially when I'm trading strangles or I'm trading NDX or SPX, because they tend to be pretty wide. I really don't care what the bid is. I don't really care what the ask is. Every broker generally will print for you what the midpoint is, that midpoint between the ask and the bid. On my platform, it's referred to as the mark. I always trade off of the mark. I'm never trading off of the bid or the ask. I'm trading off of the mark. So the mark is intended to be the halfway point between the bid and the ask. So if, say, the bid was $20 and the ask was $30, then the mark is $25. All I care about is that $25. If I'm trying to exit and I'm trying to sell for $25 because that's the mark and I'm not getting filled, I'm going to modify my order to $24.90. And then I'm going to modify my order to $24.80. And I'm going to work my order in 10-cent, 20-cent increments until my order is filled. But I don't really care what the bid and ask are doing. All I care about is how closely to that midpoint I'm able to get my position filled, whether I'm buying to open or whether I'm selling to close.
Okay. Could you explain, Tom's saying, could you explain the method you use to set up the strangles taken in the live trading room? What's the criteria for picking strikes and expirations?
So Yes, I can. It starts with having an understanding of about how much you're willing to risk. I know about how much I'm willing to risk on the trade, and I'm looking for a cost basis on the entire strangle that will fit within my desired criteria. So because the volatility has been so high, what I've been doing, Tom, is I'm going fairly far out of the money to somewhere between a 10 and a 20 delta. And I always start on the put side because I know that the put is always going to cost more than the call side. And so let's just say I went out to a 15 delta on the put and I put that on my order ticket. Then I go to a 15 delta on the call side, because one of the most important parts about trading a successful strangle is having a reasonably similar delta on each side. I want my put and my call deltas to be about the same. It'll never be exact, but I want them to be reasonably similar. I don't want them to be more than a point apart, and generally I like them to be about a half of a point difference if there is a difference. So once I've determined what my strikes are based on a comparable delta on each side, then I take a look at the cost basis. And if the cost basis is more than I really want to put into the trade, then I go back and I look at perhaps a lower delta. If I started at a 15 delta, I may go down to a 13 delta on each side. One other factor before I pull the trigger and send the order is I'm going to look at the open interest. I'm going to look at the open interest on each of those options. I generally want open interest to be over 100 contracts. And if it's less than that, it'll depend on how many contracts I'm personally trading. But I don't want to be a significant portion of the market on any individual strike. So once I've determined that, then I'll go ahead and place the order. So it's looking for a delta that's comparable on each side. It is also using an expiration that gives me plenty of time in case something doesn't work out on the trade and I need to break it apart and apply some other option management strategies. Now, Aaron shared with you that we have not been in a trade for more than 3 days. That would lead a lot of people to think, well, I could just go out a week or I just go out 2 weeks. That is, that's kind of a snare just waiting to trap you, because the minute the trade doesn't work out and you have to manage it, if you're under the gun and you have a limited amount of time remaining to expiration, you can get crunched by that trade. So right now, with it being expiration week for options, this Friday is the third Friday of March, so it's March monthly expiration on Friday. We're generally going out to May monthly expiration. I'm going out 2 months. So time to expiration, comparable delta on each side. Make sure you've got enough open interest on each option, and then make sure that the cost basis of the spread is reasonable compared to what you're willing to put into the market.
Ken's asking, I'm curious, with the strangles, it seems like you're usually looking for a 15 to a 25 delta. Would the results be better or worse if the deltas were 0.05 or higher, such as 0.35?
I think that the results would be comparable. With a higher delta, you're probably going to have a more rapid profit, but the results should be comparable, because the lower the delta, it means that on your unfavorable side, you also have a low delta. So your option that is favorable is gaining faster than the option that is unfavorable. I haven't tested really anything lower than a 10 delta, so I don't want to mislead you and imply that that has the same amount of testing. I've traded most everything from 10 deltas up to 60 deltas, And right now in this market, we're sticking with about a mid to upper teen delta. And the main reason is because it's working perfectly well. It's hitting our sweet spot in terms of profit on these stocks and indexes that we like to trade. So we're going to just stick with it for a while. As volatility starts to come down, because I know how much I'm willing to commit to each position, we're going to start to see that delta increase. We may be up in the low 20s as volatility decreases. But that's the way I look at it.
Bob is asking, would you please review option strategies that do not day trade options? And I guess that could probably tie into Mario's question as well, which is, am I right on that one? I believe, yeah, I have a smaller account size. Can I do a debit spread for the daily crosses? Do you have a suggestion for how close to the mark you would have the debit spread and how far out?
So the most effective way to day trade and avoid pattern day trading rules is you open, so let's forget about a strangle for a minute. Let's just start with a straight call or put. If you bought to open a put and you have a profit that you want to take, you want to harvest that profit on that put, but you're apprehensive or limited by pattern day trading rules, go to the next put strike out of the money and sell to open that put. And what you're doing is you're legging into a vertical debit spread. And that will, for all practical purposes, lock the majority of your profit. And then you close that spread the following day. So we were trading today and I had a call on Shopify. There was a really nice profit on Shopify. I had traded some bigger positions earlier in the day, was a little concerned about what's called day trade excess, so didn't want to close any more trades within that day, didn't want to incur any more day trade volume within the day. So I had a nice profit. I didn't want it to evaporate. What I did was I sold to open the next higher strike. And that locks in the profit because now I have a spread and both legs are going to fluctuate in value. You might get a slight amount of degradation in the overall value versus having just closed the call, in my case, a call. But what I'm doing is I'm locking in the majority of that profit, and then I close the spread the next day as soon as the market opens, and then I have all my capital back, and I don't incur the day trade. If you're holding a strangle is nothing more than a long call and a long put. If you're holding a strangle and you have a profit on the strangle, what you can do is you can sell to open a put against your long put and sell to open a call against your long call. So you're doing exactly the same thing you would be doing if you held just the call or the put, but you're just going to sell to open both. Now here's a little tip for you. You should know before you open a position whether or not you're going to close it and take a day trade. You should know. If the answer is no, open the position, and then if it's a strangle, immediately go back to your options chain and build and save an order ticket that has both the sell to open call and the sell to open put on it. And when the strangle has a profit that you would like to lock in, maybe it has a $3, $4, $5 profit, go ahead and send the order ticket that has the sell to open the call and sell to open the put. Each are the next strike available on the chain. And that way you'll lock in the profit on the strangle. That's the easiest or straightforward way to avoid pattern day trading, but still not have to limit your actual trading. You can lock in your profits.
And this works for smaller accounts too, because by selling to open those adjacent strikes, you're bringing credit in, which means that you're reducing the risk on the trade and the cost of the position.
Yeah, so Mario's saying, I guess the best question, if I was to do a debit spread and following the daily crosses, do you have a suggestion on how to close to the mark? You have a debit spread and how far out? Just go one strike further out from what you have. If you're holding the 400 call strike, go out to the 405, or maybe the next available strike is the 410. Whatever it is, just sell to open the next available strike outside of the one further out of the money than the one you hold. Richard's asking, or just saying, I did great with your option trades today. That's fantastic, Richard. So the Cycle Finder Plus is a collection of multiple indicators. So we'd been working for quite some time, especially I've been doing this when I was doing one-on-one coaching. I was working with multiple indicators across multiple time frames, and it was very manual to scan across all those time frames and indicators. And the Cycle Finder Plus, in fact, the regular Cycle Finder, the Profit Flow Oscillator, and the Trend Consensus are all a consolidation of the technical patterns and the technical indicators that we believe comprised the best signal. So Cycle Finder Plus is a collection of signals, but it's presented in a very easy to follow, simple, single signal format.
Wayne's asking if price of legging is more or same as price of long call or put, you have a risk-free spread. You have a risk-free spread question.
Yes, absolutely. Yes, it absolutely is. So if you have a cost basis of, say, $20 on a long call, and you are able to sell to open the next higher strike for $22, you have a $2 credit on a position that is normally constructed as a debit. So you have a guaranteed can't lose situation when you're able to sell to open the next strike out of the money for more than what you paid for the current leg you hold.
On a strangle, do you try to avoid having one side being much more costly than the other side? Doesn't matter.
You know, in my perfect world, Michael, I would like to have the put be probably no more than 50% more than the call. It's not practical right now. I was struggling with that a little bit. I was avoiding taking some trades that I tracked then, and they worked out quite nicely because the put was so much more than the call, like double the call. But we're just in a different environment. We're just in a different environment. So I am taking the trades as long as the overall cost basis is reasonable. And I'm taking the trades realizing that the most rapid profit that we will derive from that trade is on a downward movement. But the trade is set up to win even if we move higher. And the stocks that we're trading and the indexes that we're trading, these stocks and indexes, they move. You know, Amazon can move 100 points in a day. Booking can move 40, 50, 60 points easily in a day. All of these stocks and indexes were trading because they had the capacity to move such that a strategy such as a strangle will achieve a profit on one side and overcome the loss on the other side. It will take longer generally when the price of the stock or index is moving higher.
Jack's asking, I've been looking at a LEAP. I mean, looking at a long-term support for the SPX, thinking about getting into a LEAP. How far out in time how far out of the money or delta would you use? Something similar to the booking trade today?
Well, personally, I wouldn't be going out any further than January 2021 right now. I mean, there's certainly expiration months out beyond that, but I'm not looking to hold anything long term. And going out to 2021 was my strategy today, particularly on booking, because I think it's in an industry that's going to get some Fed support. I think it's a stock that has just been beaten down so far that even if it doesn't fully recover, there's going to be some sort of a bounce. And so I just wanted to give it time. I'm starting to think about where I want to place some trades that will take advantage of some sort of a bounce off of this extreme low that we've sold off to. It doesn't mean that I don't believe we won't go lower. It just means that the chart, so if I look at booking today, for example, the chart was telling me to go ahead and take the trade. It was right here. It was around 130-ish, and I could see that the Cycle Finder Plus on the 10-minute had crossed up from within the buy zone. At the same time, the 30-minute had crossed up from within the buy zone. And the daily is in the buy zone, although it was not crossed up. That, to me, was really strong alignment. So we took that trade, and you can see here that on that particular bar, shortly after we entered the trade, we had a little bit of a pop. That bar opened 1192 and it moved up to a high of 1215. Well, that was enough for us to go ahead and close the trade and take a profit. And then you can see that the stock trickled back lower, and because the same conditions were in effect, basically all down in the buy zone, we re-entered the same option that we had closed for less than we had originally purchased it for, and we exited out of that for a bigger profit. So I think going out to January 2021 is just an easy way to say, if I need to manage this, or if I need to be patient and wait maybe a couple of months or 3 months for things to bounce a little bit, I'm giving it time to do that. So that's really what I would do. And then if you're asking about where to place your strike or what kind of delta to use, that really just boils down to how much are you willing to put into the trade. On this booking trade, I think I was at a I think I was at a 20 delta. And that really was just because that's about how much I was willing to put in terms of risk into the trade.
Mario's asking if they opened up a debit spread instead of a straight put or call on a daily cross. Do you have any suggestions of how to buy to open the debit spread closer to the money with a higher delta, or would you bring the expiration in closer to make sure not much time is impacting the sell to open leg?
I would not adjust the expiration. I'd still keep that in place. If you're not interested in just buying a straight call or put, I would consider two things. You could buy an at-the-money vertical debit spread and put a little width to the spread. So maybe you buy the first strike at the money and then go out 20, 30, 50 points and sell to open. So you've got a lower cost basis on that spread than you would have on just buying the call or put, but you've got some room for the stock to move in price, and it's got that 50-point gap. You're basically constructing a spread with what's called a delta ratio. And the long delta minus the short delta is your position delta. And that is what you can use to determine what's the reasonableness of a profit on this trade. The second approach you could use would be a calendar spread. I personally like calendar spreads I like calendars and I like diagonal spreads, but calendars are less expensive. So on a calendar spread, let's say we were doing this on the S&P 500, and where did S&P close today? 2398. If I was opening a calendar spread, a put calendar spread on S&P 500 right now, I'd probably go down to like a 2250, maybe a 2200, and you're buying to open one expiration and you're selling to open a shorter expiration, but you're entering both at the same strike. So I'm buying to open the 2250, maybe let's say a May monthly expiration, and I'm selling to open the April monthly expiration. Both of them are a 2250 strike. Then when the price moves lower, you're getting the advantage of time value decay, much more rapid time value decay on the short leg, and that could be a nice profit for you too. So you have to kind of weigh what your comfort level is with understanding those strategies and how much you really want to put into the trade. The least expensive strategy you could use would be a debit spread, because you're going to open, let's say you only opened a 10-point debit spread, you should have a cost basis of no more than $5 on a 10-point debit spread, which means you can make as much as $5 on that trade.
Mark's asking, with the call leaps, we can always sell covered calls against it if we have another big move down, right?
Absolutely. So Mark, if we are trading a leap and we bought to open a call and we see a reversal in the signals and the move hasn't been sufficient for you to take a profit on that call, you just sell a call against it. You sell a call against it. Now you've legged into a spread. You've dramatically reduced your risk basis on that position, and then you write it down. And when the next reversal to the upside presents itself, you buy back that call that you sold. And you could sell it anywhere, Mark. You can sell it in the same expiration period, or if you were holding a long call with a January expiration, you could come back and sell April if you wanted to, because then you're going to get the advantage of the time value decay, the rapid time value decay.
Because asking, would buying leaps be wise with the, I'm assuming the
Implied
volatility so high?
You're looking at implied volatility, I'm assuming, across the market. I'm looking at individual stocks for these trades. And yes, implied volatility is generally higher, but I'm confident in my ability to manage any one of these if implied volatility were to completely fall off. But more importantly, I'm following the signals. Remember, on booking, we had a perfect setup. Doesn't guarantee it's going to work out, but we're also not holding on for a long time. We only gave ourselves a lot of time to expiration so that we could have time to manage it if necessary. And again, if you're not comfortable with it, if you think it's not wise for your account, you shouldn't do it. But I think it's a perfectly fine strategy considering the signals that we're following. Folks, I don't see any other questions out there. We're available for a few more minutes if someone has another question. Right now I'm just looking at overnight futures. Have you seen it, Michael?
Yeah, we're up a little bit, aren't we? Yeah, we're up. Yeah.
Dow futures are up 632.
Yep.
NASDAQ futures are right now showing up 257.
Yep.
S&P is up 72 and Russell's up 52. Arizona, Mark, there was a rule change on calendar spreads a few years ago, but that changed. It may not have changed for every broker, but they were limiting them a few years ago, but that's changed. I still enjoy doing calendar spreads. Mike is asking, are you holding any open positions and what are the drawdowns? It's not really a relevant question, Mike, because the drawdowns are going to change day to day. The only ongoing position that we've held is Google, and we've been in Google for about 2 weeks. It's a call, and it's a May monthly expiration, so we've got 8 weeks to expiration. So we're just, kind of waiting for either a bounce on Google or some indication that we may need to take management action. But so here's what happens, and the reason I don't think that measuring drawdowns is really relevant is because we look at the overall portfolio. Today, we took profits on Tesla. We took profits twice on Booking. We took profits on Amazon. We took profits on Netflix. We took profits across multiple positions. But at close today, we were holding another Amazon position. We're holding another Tesla position. We're holding a Shopify position. We're holding a Google position. So there's always going to be some level of drawdown on positions that we haven't closed yet. And that's why we haven't closed them. But we've built time to expiration in each of these positions. The other way to measure it, and I think this is a more appropriate way to measure, a lot of people focus on the drawdowns, they get a little paranoid about those. On my trading platform, there is a numerical value for the account that is called live account value. And it means that no matter whether you have a profit or loss on any one of your individual positions, if you were to close everything that you hold right now, regardless of profit or loss, this would be the remaining value of the account. That would then transition to a cash value of the account. So what I do on a weekly basis is I measure live account value. If live account value is not growing, then I need to make adjustments. If live account value is growing, but I'm holding 1 or 2 positions that have a drawdown to them, it doesn't really matter to me. I've got other positions that are making up for that, and I've got time to expiration built into the position, and that position may still end up becoming a profitable position, or it may end up becoming a losing position that is a smaller loss than what I'm seeing right now. But the direct answer to your question is I'm not going to count any of the positions I opened today, and I only have 1 position that I'm carrying from prior to today, and that position is a Google call. And
which has only been held a week as of today. You said 2 weeks. I know it's felt like that because we closed positions in 1 to 2 days, but we opened it up on the 11th. I went and double checked that.
Honestly, it feels like we've had the position for a month because we're so used to closing everything out same day or next day. But bottom line is we're down about $10 roughly on that position, about $10. All the other positions we opened today, one of them had a profit that we locked in today and we're going to close tomorrow. One of them had a small drawdown. Another one had a small drawdown, but they're really not significant.
Actually, one of them has a small profit as of close.
I like that even better.
Mario said, do you think the announcement of the New York NYSE floor is closing and moving to only electronic, does that slow everything down that you could think of? Well, Mario, you've been trading electronically all week on the CME. They've been closed on the floor. So I talked to Glenn about it at Affinity, and it's no change. You shouldn't see any change. I wouldn't think so. I know we've been trading all week on the electronic on the CME, so I ain't seen differences, but.
Wayne, so first of all, I appreciate you being here, Wayne, and I'm glad that you have our prior programs. What are you looking at specifically when you say, please send me all strategy information? We can steer you to our if you're looking for how to re-engage right now, my my best recommendation would be you got to start with the technical signals, and that means a subscription to the profit flow analytics charts and the masterclass, subscription to the masterclass, because with the masterclass you get the Cycle Finder Plus. And from there, you can decide what strategy you want to use. If you want to use option strategies, which I think you're familiar with many of them, or if you want to understand future strategies. But I think everybody needs to start with a technical tool that tells you when to get in. If you know how to trade and you know everything there is to know about straddles and strangles and diagonals and calendars and all that on options trading, and you understand fully about futures, you understand all of that, and you're an expert in it, but you don't know really when to open a position, none of that other stuff matters. We've invested years in building technical tools, and we partnered with New Cycle Trading here last year, built an amazing program and technical signals that will tell you when to open a position. From there, it's up to you to decide what strategy you want to use to take advantage of that signal. And Wayne, if you want more information on that, you can certainly email us at bob@optionsmoneymaker.com, and Bob can, you and Bob can talk, and he can help guide you to where you want to be, how you want to get re-engaged, and get you started with the masterclass and the New Cycle Trading and Analytics charts, which is really where, if anybody was asking me right now how to get started, that's where I believe everybody needs to start. So that's Bob at New Cycle, sorry, that's incorrect. That's Bob at optionsmoneymaker.com. Thanks, Wayne.
And Wayne, I sent you his email too. I wrote it down for you as well.
So here's the last little tidbit. I'll give you guys a chance to see if there's any last questions. Stocks that we trade in what's called extended hours trading. Amazon's up 39 right now. All this can change before a regular session open, but I tend to look at it several times throughout the evening. Amazon is a stock we trade. We hold a position on Amazon. Extended hours is up 39. Booking is not showing any extended hours.
16.
Up 16.
Yes.
Thanks, Michael. We don't hold a position on Booking, but it's up 16. We hold a position on Google, our call, and it's up 29.60. I like seeing that right there. That's awesome. We hold a position, let's see here. We don't hold a position on Netflix, but it's up 11. We hold a position on Shopify. It's a call position, and it's up 11.5. And we hold a position on Tesla that is a call, and it's up $11.78. So if we opened right now where we're seeing the extended hours trading, I think we'd be pretty happy with the positions that we're holding. Well, that's really the million-dollar question, Tom. How long do you think we'll have this high volatility? I can't tell you. It doesn't really matter to me other than I like it. I like the high volatility. I think it is a lot of fun. It's exciting. It's an amazing way to be able to trade. It's actually pretty easy to trade if you understand what you're doing. I love it. But I don't really see the market settling down until, this is my personal opinion, I don't see the market settling down until there is a perception by investors, by institutional investors, by businesses, that this coronavirus issue has started to diminish, and that maybe we're on the other side of the curve where things are starting to quiet down. There's a vaccine, there is a solution, and it's not a frantic every day look at the news and there's some new fear-based story talking about this virus. I don't think things are going to settle down until then. But in the meantime, nothing ever goes down, straight down, and nothing ever goes straight up. So even if we were to continue trending lower, we're going to cycle higher at periods of time before we turn around and head lower. If today was the last day of downward bias movement, which I don't think it is, but if it was, we would see some movement higher, and then we're going to see some movement lower before we move higher again. You're going to see cyclical movements no matter what direction we're trending. One of the best opportunities to understand how to track that is be in our live trading room. Michael is really our subject matter expert in terms of very advanced technical tools that we do not teach, and assessing those, whether it's on a stock or an index or a futures contract, and helping us determine we could possibly move up to this price level or we could move down to that price level. We talk about that all day long in the live trading room. And then in addition to that, we talk all day long about where the technical signals are aligning and what positions I'm taking or what positions Aaron's taking. So I think there's a huge advantage to trade this market, not only to learn how to trade, but really earn from this market by being in the live trading room. Dennis is asking, when do you think you'll start trading futures again? When I don't feel like I'm going to get smacked out of the trade 30 seconds after I open it by being stopped out. All right, folks, we're going to go ahead and close out now. Let me just say I sincerely appreciate all of you being here. Aaron and Michael, I appreciate you being here, appreciate what you do every day for our clients. We are committed, folks, to doing everything we possibly can to help you learn and also help you earn. And if that's something that you want, then be in our live trading room, participate in the Profit Flow Analytics charts, the masterclass, so you have access to the Cycle Finder Plus, and we will help you as best we can.
Okay, Mark, just one more quick thing. Now,
Yes.
this will be it. So you got my curiosity up. So August of 19, if you'd asked me where we're going, I would tell you it was going right here because that's where the target was. We've hit the target.
What are we looking at?
NQ, the NQ futures.
NQ.
Yeah.
August.
So in August.
Okay. August 2019.
Yeah, August 2019.
Mm-hmm.
That's where some of the lows were, and then
I can't go back that far. Okay.
Yeah, so that's where some of the lows were on August 19.
Mm-hmm.
So the target told us we was going to get there between February the 24th and May the 7th. So it made it. So here's what's going to happen more than likely. I'm not saying we're done to the bottom yet, but we're going to pull up. Then we're going to make one more gasp to go down, and that we could go down to 66.94.
Okay.
And then we're going to have the biggest rally you ever seen in your life. I can guarantee you that. I ain't gonna guarantee it, but that's what the chart looks like. And I'll tell you where the target's at. Target's at 10,192 right now is where it's at. That's a big change.
It's about 2,800 points above where we're currently trading.
Yeah. So I think you'll see that.
And the best way, folks, to know when that's happening or when that's starting and follow the cycles along is to listen to Michael every day in the live trading room. It'll be the best time that you've ever invested in your trading. Yeah, I appreciate that, Michael. That's awesome.
No problem. No problem.
Last question goes to Wayne. You day trade ES futures. How about SPX? ES futures are one of the futures contracts that we're monitoring, but we're also taking trades on the S&P Cash Index. We're doing options trades on the SPX Cash Index. All right, we're going to go ahead and close out. Thank you so much, everybody. Talk to you in the morning, 8:45 Eastern.
Huh? That's right. Bye.
You don't have to be there, Michael.
Bye. I'll be there. Bye.